To start sharing my screen too. Yeah. So in the previous session, we talked about, or we started with the discussion upon the valuation ratios from a different perspective, right? From the most practical perspective that we can understand and try to implement those valuation metrics in the real life fundamentals, right? In trying to do the valuation for a company, we're trying to come to a conclusion for our analysis, that is whether the company is undervalued, overvalued, or fairly valued. And again, we also came and tried to understand various factors, various advantages of the price to earning ratio and disadvantages as well, and where the price to earning ratio lags. And where it lags, the price earning growth ratio tends to come into place. That overcomes mostly all the limitations of the price earning growth ratio of the price to earning ratio. And that is why we have the price earning growth ratio, right? And we talked about the relationship of the price to earning ratio and the price earning growth ratio with the interest rate, risk, and growth as well. So all these things we tried to analyze in a very deep dive manner to understand it from the most practical viewpoint. And in this session, we shall talk about the price to book value ratio. Very brief sessions I'm trying to keep up to make you understand all these ratios from the most fundamental point of view so that you guys can understand and apply these metrics, these valuation metrics in your day-to-day work, right? So that is something. And one more thing, you have to be much more conscious about it or much more aware about the fact is a company that might seem overvalued might not be overvalued always. I'll repeat my point. A company which might seem to be overvalued based upon multiples, based upon pricing, right? It might not be overvalued in the real sense. Whereas if a company is undervalued, again, it might not be undervalued in the most realistic sense. And I tried to make you understand this logic in the previous session while you were trying to understand the price to earning ratio and the price earning growth ratio, right? So these kinds of practical examples we tried to take into account in the previous session. So if you haven't watched the previous session, please watch the recordings. All these practical understandings and implications have been clearly taught in those sessions. Okay. So यहाँ पे, if I talk about the price to book ratio, right? And if we have time, we shall begin with the other EV to EBITDA ratio as well. But first thing is the price to book value, right? It has the current market price of the share in the numerator and the book value per share in the denominator. So that is the book value per share in the denominator. So in the numerator, you are having the current market price of a share, and in the denominator, you are having the book value per share. Now, be it the price to earning ratio, be it the price to book value ratio, the numerator is same in both of these metrics, in both of these fractions, or in both of these valuation ratios. We tend to take into account the current market price of a share. So if I am calculating or the latest available market price of a share. So for example, if as of today, on 8th of March 2025, I'm trying to calculate the price to book value of a company, I'll be taking the latest available price with me. And that shall be the yesterday's closing price, Friday's closing price. If I'm calculating it as on Monday, I'll be taking the closing price as on Monday, right? And the same logic holds true for the price to earning ratio as well. So the logic for the numerator, that is taking the current market price, stands the same for both the price to earning ratio and the price to book value ratio. And from a previous understanding, from a previous live sessions, we always know that the current market price of a share or simply the price of the share is a leading indicator. It is governed by sentiments, maybe some positive sentiments, some negative sentiments. If there are some positive sentiments, the stock price might rise. If there are some negative sentiments, the stock price might fall, right? Because all these kinds of sentiments, all these kinds of positive news, some negative news, some positive commentary, some negative commentary, all these things tend to come up daily in the market. Some analyst is commenting upon some stock. Some researcher might publish some research report upon that particular stock or company. There might be some management guidance. There might be some quarterly meetings, some weekly meetings in which the management might say something. There might be some FII selling or domestic selling on account of some negative sentiment upon that particular stock. And even if those kind of news are not there, the price of every company tends to fluctuate on daily basis. It might not fluctuate by a significant margin, but at least it will. It can be 0.00001%. Here and there some decimal points, but the market price of a share tends to fluctuate. The volatility of the fluctuation might be less, but it will fluctuate, right? And that is why we tend to call the market price of any of the company or any of the stock, which we take into account in the numerator, as a leading indicator. And in the denominator, we have the book value per share. I'll try to make you understand why the price to earning is different from price to book and vice versa. But in your denominator, we are again taking a book value per share. It is again a derived metric. For all of those who know about the price to earning ratio, in the denominator, we used to take the earnings per share, the EPS, the earnings growth of a company. And EPS was again a derived metric from the profit after tax. EPS is a proxy of the profit of a company. EPS is calculated as the profit after tax divided by the outstanding shares. Again, similarly, in the book value per share, it's again a derived metric. Similarly, as earnings per share, correct? And how do we calculate the book value per share? Simple way. The first thing is if you're trying to calculate the book value per share, BVPS, as we tend to popularly call it in the world of finance or investment banking, BVPS, book value per share. So you might not find the whole word everywhere, right? Ki book value per share. You might find this BVPS, like moneycontrol.com, or for example, if I talk about screeners, right? So like most of the time we tend to mention BVPS and people tend to get confused, right? BVPS, book value per share. So the formula for the book value per share is the book value of a company. I'll come to that part ki what is book value divided by the outstanding shares. The outstanding shares ka logic is same as EPS. The profit after tax divided by the current outstanding shares. How many liquid shares are there in the market to be bought and sold in the secondary market and not the primary market? Here in this case, in the outstanding share component, we just talk about the liquid shares, the most liquid shares, which you and me as the retail guys or the FIIs guys or HNIs, the high net worth people can buy and sell in the secondary market between you and me. These are not the transactions between me or the company directly in the primary market or some other kind of a party and the company in the primary market. All secondary market or liquid shares, right? Same logic as your EPS, right? But if we talk about the book value per share, what exactly is the book value? If somebody asks you what exactly is the book value, it is simply the total assets minus total liabilities. The total assets of a company minus the total liabilities of a company, right? So, and one thing, see, total assets, and here I'm talking about the total assets you see simply in the balance sheet. You go to the balance sheet, you take out the balance sheet from annual report, from moneycontrol.com, from BSC NSE website, the total assets ka number, plain vanilla, just put in there and subtract the total liabilities. All the current liabilities, non-current liabilities, subtract the total liabilities section from the total assets. And logically, if we know about the balance sheet of a company, that how does the balance sheet of a company works? The difference between the total assets and total liabilities was nothing but the equity of a company, the shareholders' equity, which comprises of all the profits, all the reserves, all the surpluses, right? We all know about the basic balance sheet equation that we learn in accounting in class 11th and 12th. Assets is equal to liabilities plus capital. Assets A is equal to liabilities plus capital, L plus C. And when you take this liabilities on the left-hand side, simple maths, A minus L, it gives you the capital. And what is the capital? Capital. It is a stockholders' equity. Correct? So if we subtract the total liabilities from total assets, we get nothing but the total equity or the shareholders' equity. Correct? It is also called as your net worth. Your net worth and book value are the same. Net worth of a company. We talk about net worth of individuals, correct? Same logic we tend to take into account. If I want to calculate the net worth of Mr. Ambani, I won't be seeing that how much cash he has in the bank account. No, I'll be taking all the assets that he has, his cash balance, his properties, his cars, be it depreciating, appreciating, be it land, be it properties, be it jacuzzis, be it some kind of homelands in some other countries, stock market investments, fixed market investments. I'll be taking the total of all of these as my total assets and then subtracting his total liabilities out of that to calculate the personal net worth of Ambani and not Reliance, I'm saying. But the formula remains the same for a company, for an individual, right? But when we are calculating the net worth in case of book value, we tend to modify it a bit. What mostly analysts are doing in the market, and I'm saying 60 to 70% of the analysts are doing in the market, they subtract one more thing. And what is? They subtract the intangible assets too. So that becomes what? It becomes your total assets minus total liabilities minus the intangible assets. It might be patents, copyrights, trademarks, some kinds of softwares. So intangibles, they are subtracting from the total assets, right? Because intangibles are something which are particularly being oriented towards what, to a company itself. Yes. But ideally, they want to know on account of total tangible assets, which you can feel and touch. On the basis of that, because it is much easier to sell off those assets in the market versus intangible assets. It's very, I agree, it's very, very difficult. It's super easy to sell off a current asset, right? It's difficult to sell off a fixed asset, maybe plant, machinery, land, building, property. But much more than that, it's much more difficult to sell off an intangible asset, patents, copyrights, trademarks, because all kinds of regulatory actions, all kinds of monopolistic and trade policies, Act of 2002 or something, all these things tend to come into place. It takes a lot of time, approval, sanctions, process, paperwork, red tapeism to sell off those intangibles. And that is where we are subtracting those intangibles also. So it's your total assets minus total liabilities minus your intangible components. It gives you your equity, the stockholders' equity approximately, or the net worth of a company. So this formula we simply use in the numerator and divided by the outstanding shares. But simply, if any of the corporate interviews or anywhere people tend to ask you now, yeah, please tell us what is the book value of a share. Book value is nothing but the net worth of a company. Book value is nothing but a net worth of a company. It is the worth that if the company is liquidated as of now, अगर आज मैं अपनी कंपनी बेच देता हूं मार्केट में तो उसकी कितनी वैल्यू होगी. Book value is the value of that company if as of today I liquidate my company as of now, मैं मार्केट में अपनी कंपनी बेच देता हूं तो उसकी कितनी वैल्यू मुझे मिलेगी, मेरी कंपनी की वर्थ कितनी है. How much is the net worth of my company based upon all my tangibles deducted via the total liabilities and intangibles. Simply, मेरी कंपनी की कितनी वैल्यू है in terms of my assets and liabilities. That is my book value. And I divide it by the current outstanding shares. And I get the book value per share. And this number I take in the denominator of the current market price. This whole calculation, very simple, straightforward from the balance sheet, nothing to calculate specifically, no assumptions, no complications, no adjustments here and there. Simply this number is taken in the denominator. These valuation ratios are very straightforward. It is just the meaning you need to understand. And we get the price to book of a company. The current market price divided by the book value per share. And again, the same kind of interpretation holds true for the price to book value ratio also, as we talked about the price to earning. Everyone in the market says higher the ratio, it is overvalued, lower the ratio, it is undervalued. But on account of our learnings via the modules, via the live sessions, we have understood that even a higher valued company might not be really high valued. And vice versa stands true for an undervalued space as well, right? So again, the same logic holds true. If we want to judge whether our company is undervalued or overvalued, again, we'll compare our company with a similar company in the same sector. I'll be taking the averages of all the companies, or simply if I have an IT company, I'll be taking the past 10-year average at which a particular company is trading. So for example, these ratios are basically being used for the banking industry. I'll tell you why. Right. So for example, if the average Nifty bank ka price to book value is 2, for example, hypothetically, it ranges between 3 to 5, right? ले लो, just take it 4, okay? And if my company, my private sector bank or public sector bank, which I am valuing, is trading below 3, it means it is undervalued based upon the past 10-year average. Usually they tend to take a 5-year or a 10-year average. Taking 15-year, those analysts, like to be very honest, who take 15-year averages or 20-year averages or 30-year averages, and they say our company is undervalued or overvalued based upon the 30-year average or 20-year average or 15-year average also, it doesn't make sense because averages tend to change. Multiples tend to re-rate. The company's performance changes. What was there in the market 10 years before is not there right now. Right? So 15 years, 30 year down your line ke basis pe, how can we compare multiples? 5 years and 10 years still fine. Right? Those who calculate 30, 40 year ka kuch sense nahi hai. Okay, to be honest. Right? So average we are seeing of an index and seeing whether our company is undervalued based upon that index average or not. If our company is trading at a higher price to book value multiple versus the average, in that case, our company is overvalued. But if our company is trading at an undervaluation, at a lower multiple than the average, then our company is undervalued, right? Just give me a second. Right? So that is one thing, as we talked about. ठीक है, so वही हमें देखना है, because many of the people on many of the YouTube videos, many of the platforms tend to say like if the ratio is less than one, it is undervalued. The ratio is more than one, it is overvalued. And these things I'm not saying for the first time. I've been repeating these things for all my valuation lectures. If you guys are consistent and watching modules, my live videos, my live lectures on social media platforms, right? So again, that is something which is very critical. You need to understand. Always compare with averages. See, so basically, how to interpret this ratio. So it basically tells us the price to book value ratio basically tells us how much worth we are ready to pay for a company having worth $1 of book value. अगर company की net worth is of $1, on the basis of that $1 net worth, how much we are willing to pay for that company. And again, the book value of the company should be as high as possible. Why? Because we anyways want the total assets should be more than total liabilities. If the total liabilities are more than total assets, again, the book value shall be negative. And for negative book value companies, we cannot calculate the price to book value ratio. Same logic as price to earning. If your EPS is negative, you can't calculate the price to earning also, right? So anyways, we want the book value of the company should be as high as possible. The company should have as high tangible assets, right? That shows the strength of a company, how strong the net worth of a company is, right? And if that becomes your denominator, and if we see that the net worth of a company is surely high, the assets are super strong, but the price of a company at which it is trading is very low, we can clearly see the company is undervalued. On the basis of the positive net worth of a company or the strength of a company, the company deserves a higher share price. वो सस्ते पे क्यों बिक रही है मार्केट में, right? The company deserves a higher share price, and that is something we try to understand in case of the price to book value. But if in the other scenario, the book value of the assets are too low, it means that sum of the total liabilities is closer to total assets, or the assets are less, but the price at which the company is trading in the market is very high, बहुत महंगी बिक रही है, but the worth of the company is very cheap, it is very low, right? Then why to give a higher multiple to that company? Why people are purchasing that stock? In that case, the company might be overvalued. The assets or the net worth of a company is not supporting the price, correct? So that is one thing. Ab, for what type of industries we tend to use this price to book value ratio? But before I talk about the industries, any questions, anybody? Any questions anybody wants to ask me regarding the price to book value till the point of time we have understood as of till this point? Any questions on price to book value? Formula wise, calculation wise, interpretation wise? Any questions on price to book value? Anybody? These are very quality sessions, super quality sessions. No one in the market will give you this quality, I'm telling you. They will give you the fancy presentations, right? Of trying to present things and all that stuff. But the quality of the content. So ask me questions. No questions? Okay. So I'll talk about which industries we can use this price to book value. So price to earning, if I talk about now, I'll come back to my previous sessions, price to earning. So price to earning is a ratio which can be used for any of the industries. People are using that ratio for to value any of the industries. But I personally believe, or many of the analysts in the market also believe, that price to earning ratio is something which should not be used for heavy companies, heavy industrial companies like infrastructure, real estate, some kind of capex oriented themes, cement, metals, defense, right? Heavy industrial companies may price to earning should not be used. Their price to book value should be used. All kind of heavy companies that you find. EV to EBITDA is also used. We'll come to that metric, but here we are talking about just price to book value. It is being used for heavy industrial companies. For lighter companies, asset light companies like IT, it can be tech, somewhat medium oriented companies, medium oriented asset companies like pharma, like your FMCG, price to earning good. right? But price to book value should be morely used for asset intensive businesses. Automobiles में price to earning use होता है, price to book value again can be used, a very good metric. Because these businesses, I know earnings are important. Earnings are very important for a business. More than earnings, it's cash flows. But ideally, these businesses book values the assets the businesses has. If there is a refining business, a metal business, the different kinds of ferrous metals, non-ferrous metals, plant, machinery, they have thousands of big machineries, sophisticated and complex machineries on which the workers are working. Those are the book value for that company. Cement is the book value for the company. Cement, its raw materials, your heavy real estate, your marbles, all these kinds of tiles, infrastructure, cements, all these are the book value for that company. So the valuation for these companies should be judged upon the book value these company has, कितने assets company के पास हैं, shipbuilding companies, road building companies, all kinds of heavy industrial infrastructure companies. I won't be naming the companies. My profession doesn't allow me to name the companies, but you should get a clear sense कि मैं किस companies की बात कर रहा हूँ, right? So that is the thing. Most importantly, it's used in the BFSI space, be it private banks, be it public banks, be it NBFCs, be it insurance, any kind of NBFCs, consumer NBFC, like automobile NBFCs, any kind of NBFCs you talk about, it's used there as well, right? I won't say particularly it shall be used for the fintech companies, because for fintech companies, what happens is more of an asset light model. They tend to operate on a low scale via the online mode only. But all those private sector banks which have physical operations ideally, or all those, I would say, fintech companies that provide loans, because not all the fintech companies tend to provide loans, right? So all those companies which are into the financial space, insurance companies, asset management companies, though they have different metrics also, AUM as a percentage of book value, or like AUM as a percentage of GDP, all these things they tend to talk about. But it's being used for those set of BFSI space, because the book value for those companies is the loans, right? The bank works on loans. बैंक की book value क्या है? How do you decide the worth of a bank apart from the net interest margin upon the loans the bank has? Because again, the net interest margin is being paid or received based upon the loans only. The bank takes loans and give out loans, and the rate of interest at which it gives out loans and takes loan is the spread, and that spread is called as a net interest margin, NIMS, right? The book value for the banks is the loans. And why I'm stressing upon the book value for banks and not earnings? Earnings are important, but why I'm suggesting upon the book value? Because the book value is adjusted against the provisions. 100 crore के लोन है, कितने प्रोविजंस हैं? 20 crores के प्रोविजंस हैं, 10 crore के प्रोविजंस हैं. If something bad happens to the company up to the extent of 10 or 20 crores, the company can manage that. So that those book value, that is nothing but the loans, are adjusted against the provisions. And that adjustment is not given in the price to earning ratio. Price to earning will just give you the EPS. It won't give you the adjustment. But bank's business is based upon giving loans and taking loans. So one should value banks based upon the book value of the loans, being taking loans and giving loans, and the total net quantum of loans being adjusted against the provisions for bad debts, right? So that is something we tend to take into account in terms of banks. If someone asks you, and if anyone is valuing banks based upon price to earning, is completely wrong. I'm saying it straightforward. Those who value banks based upon a price to book value are 100% correct, because the bank should be valued based upon the book value, and the book value is nothing but the loans, and only the book value can be adjusted against provisions. Earnings can't be adjusted against provisions mathematically via accounting or financial techniques. So that's the logic you can give in there. So that is where the price to book value is extensively used in case of banks. And the reason I told you right now, why for banks, why for NBFCs, why for asset management. Asset management companies not exactly price to book value, but basically for your private banks, public banks, NBFCs, and fintechs that lend loans. Some asset management companies that tend to lend loans up to that vertical, or like up to that, I would say that unit only, right? Because they're mostly players on brokerage, upon asset management revenues, upon operating expense. So that's a separate topic we'll discuss somewhat later. But price to book value ka exact implication or interpretation is this. Any questions anybody as of now for the price to book value ratio? Very important ratio. And I'll tell you one more thing also. बहुत बढ़िया बात बताऊंगा. This price to book value ratio na has a relationship with the ROE of a company. the return on equity of a company, or simply you can say price to book value also has a relation with the return on capital employed of a company, right? They have a relationship. Though we aren't going towards the regression tools, if we talk about regression, we try to regress these things and try to establish a relationship between dependent variables and independent variables. We are not going that thing. But the thing is, if any company you find, this price to book value is low. Any company you find, this price to book value is low, right? But the return on equity is high. And I would say the best way is to use return on equity and not return on capital employed. Why? Because total assets minus total liabilities give us the stockholders equity. जब हम liability subtract कर ही चुके हैं, then why to establish a relationship between the price to book value and ROC? Because just the equity component is left, right? But still you can judge it based upon ROC also. उसमें कुछ बुराई नहीं है, because the logic matters more here and not the consistency of the multiples, right? If the price to book value is low, मतलब company सस्ती है, the company is selling off cheap in the market. But the ROE or the ROCE of a company is very high. We talked about what is ROE. We know what is ROCE. We have tried to differentiate between both these metrics also in the previous live sessions and recordings. Watch those sessions. तो अगर किसी कंपनी का प्राइस टू बुक वैल्यू इज लो बट द ROE and the ROC is high, or any of those is high, right? Depending upon the capital structure of a company. For debt companies, we tend to use ROC. For equity companies, we use ROE. That is high. It means the company has a very high potential. The company is able to deliver good quality earnings to its capital providers, be it equity holders, be it debt holders, but the company is trading at a cheaper value. A company having a higher potential in the market, giving higher returns to its stakeholders, shareholders, but trading at a very low valuation deserves a higher valuation. Go for that company and buy that company. That's on account of price to book value. Lower price to book value and higher ROE and ROCE. That's a good relationship. But if ROE, ROC is extremely low, 5%, 4%, but price to book value is high, that company is not delivering anything to the shareholders or to the capital providers. It's overvalued. Sell off that company or try to understand that company in a much better way. So that's the kind of relationship we need to understand. Any questions, anybody? Any questions, anybody?